Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week will be an episode with me talking to you about the basics of AI. We just spend so much time on this podcast and at Upstart talking about AI. I really wanted to give an overview of AI for lenders specifically, talk about what AI is, some of the key components, talk about the use cases in the lending environment specifically, where I see this being applied, and then just talk and touch a little bit on some of the challenges you should be aware of when you're thinking about the application of machine learning or artificial intelligence to lending. So that'll be today's episode. We'll dive through these topics, and hopefully you can learn a little something that's useful for you as you think about how AI can be applied to your business. Okay, so let's start with an introduction to AI. So AI or machine learning, I kind of prefer the term machine learning, but at the core, this is about taking data on the past and using it to build a model that can help us predict the future. And so I want to talk about the core components of that. And the first one is the data you're learning on, what we typically in machine learning call the training data. And I like to think of your training data as a big spreadsheet with a lot of rows and a lot of columns. And in this case, the rows are the items you're learning from. In the case of lending, maybe historical loans, historical applicants. They're one unique entry into that database. And then the column is each piece of data you have about the individual. In the case of an underwriting model, it might be each individual variable you can get from the credit bureau. Could just be a credit score for some simpler models, could be several hundred pieces of data, could be alternative types of data. But the columns are kind of each thing you know about that individual in the case of lending that you're going to use to try and make a prediction in the future. What are the things that I know? And so there's obviously a big question we'll talk about where do you get the training data to start from, which is a large problem in machine learning. But there's also this question of like, how do I get my columns, right? And one of the most interesting things I think that will make a lot of sense to people is this concept of what we call feature engineering. It's a fancy word, but it really means taking some of the columns we know and other pieces of information and using it to generate additional columns of data. The most simple version of this that almost every lender uses is just a debt to income ratio, right? Like the two things you know about a borrower might be their debt and their income. And we use those two together to make a variable that's more predictive than either their debt or their income, which is the ratio. And of course, there's lots of ways to do a debt to income ratio. You can go engineer a payment to income ratio, a debt to income ratio that excludes certain things, right? That maybe looks at housing or doesn't look at housing or looks at certain kinds of payments. And so another example of this is just credit utilization, right? We might have total available credit, total outstanding credit, and we can make the credit utilization of different kinds. And so there's lots you can do to take the training data you have and enrich it by kind of engineering new columns by looking at the pieces of data we have. The second key thing is now that I've got my training data set, right, my big spreadsheet that I'm going to use to train a model to make predictions about the future, I need to ask it, what am I going to ask it to predict, right? And so that may seem simple, but there's actually a lot of thought that can go into what are we asking the model to do? What's the work we want it to do? What's the thing we want it to predict? In underwriting, the most simple example is this a good loan or a bad loan? Yes, no, binary, will default, won't default. It's a very simplistic thing to ask it to do. You might start to have more, it can be a binary good, bad. You could also get to something more granular like a probability of default. What's the likelihood from 0 to 1 that we think this application, this loan is likely to go bad, right? That's a little more granular than good, bad. It could give you 10%, 20%, 30%, 40%, which gives you the ability to maybe make a more granular decision, to understand the risk level you're taking on more specifically, to price more specifically. In the context of fraud, you could have something as simple as, fraud yes, fraud no. You probably want different kinds of fraud signals. So different things you could ask, is this person lying about this or lying about that versus is this a fraudulent application? In the case of marketing is a great example where you may be asking a model to predict, will this person respond to a piece of marketing? Will they come to the site and actually apply? Will they likely to be approved? Are they likely to convert? Those are all different questions we could ask the model to predict for us, each of them with pros and cons. Right, and so this is one of the things you'll find in machine learning is that it's not simple to apply. You've got to understand the limitations of your training data, and that may inform the outcome that you're trying to predict. Am I going to ask this model, is this person likely to get a loan when I market to them, or just are they likely to come to my site and respond to it? And they may both be useful questions, but you need to understand what you're asking for. The third thing to really think about is what's the form of my model. So if I now know, what I've got to train the model, what I'm asking it to predict. my next real question is, what's the structure of the kind of algorithm? If you think about the most common form of machine learning, and I do call this machine learning, like a linear regression, right? The form of the model is a line. It's got two variables, right? The x and the y-axis, and we're going to draw a line through our points and try and give our best approximation. And that's a linear regression. There are obviously much more complicated forms, logistic regression being kind of the next step up, and then you can get into, binary decision trees, boosted trees. You can get into neural networks, and the details of these model forms are kind of outside the scope probably of this podcast, at least today's session. If you guys are interested, we can dive into that more in a different session. But it is important to note that you need to think about what forms, each form has some limitations. How many variables can it effectively utilize? How much training data might it need to be able to make a good decision? Neural networks don't work with small amounts of data. They need very large amounts of data. So you need to kind of make the right decision on the form based on the kinds of things you're trying to predict, the kinds of training data you have, and other factors. So that's another of the key things that to figure out in a machine learning context is what's the right form of my model? And this may shift over time, right? And the last thing is, how do I measure if it's being accurate? And this is a place where for many lenders, I think, you start to get metrics that are not standard. We might be used to seeing default rates in a portfolio by credit score, and you can generate those, but typically machine learning scientists, data scientists look at more specific metrics, ks-stat, log loss, RMSE, the root mean squared error. So more statistical metrics that are looking at, if you think about that example of a bunch of dots and a line through it, how far away on average are the dots is roughly what you can think of as RMSE. It's like, what's the average error that I've got across all of my training data? So I'm getting a metric of how accurate the model is at making a prediction. Of course, there's also sometimes times that you might want to have different kind of metrics. Upstart has built several internal metrics that we think are more useful metrics for the accuracy of the model in the context of lending. So another key question, if you said, I figured out what my training data will be, I figured out what I want it to predict, I figured out what form is best for me to use, now I got to figure out how I want to measure the accuracy of this model. Is it improving or not improving, and how is it changing over time? And of course, the challenge for all this, for a machine learning use case, is that in machine learning, this thing is constantly learning, it's changing. And so the answer to what's my training data, do I need to do more feature engineering, what's the right form, what's the right accuracy metric, maybe things that shift over time, right? And so it's not a static answer, it's really an evolving thing. And there's still a lot of work that goes on in our world in all these areas to figure out what's the best way to build a machine learning model to achieve the outcomes that we want. So that's the basics of machine learning. We had a bunch of training data. The basic process of machine learning is also beyond the scope of this, but it's essentially, I'm going to go back to that example of a bunch of dots on an XY graph, and we're trying to draw the line through it. It's just trying a whole bunch of different lines and trying to find the line that has the least error by the accuracy metric we've chosen, where the dots are closest to the line. And of course, it's much more complex in multi-dimensional space with thousands of variables, but the principle is the same, which is we're trying to use all the data points, all the columns, to make predictions about some outcome that we have for our training data that we want to predict for future people. So we know if historical loans were good or bad. We want to predict if future loans will be good or bad. We know all the things we knew about the old loans, and we want to build the most effective formula to make that determination using pretty sophisticated techniques. So it's not simple algebra. It's not going to be just a line. But I think if you think of that linear regression example of a line through a bunch of dots and trying to find the best fit line, it's a pretty good mental model for conceptually what's happening. So that's, I think, the basics of, some of the four core fundamental concepts for machine learning, artificial intelligence that are useful for lenders. Let's talk about where you can use this in the context of lending. And I really see use cases across every aspect of the lending life cycle, if you will, where this is applicable. But let me talk about four that really come to my mind as the key things we want to do. And I'll just kind of go through them sequentially as a consumer might or a customer might of a lending process. The first is like marketing. And you can imagine the number of problems that you can apply to machine learning. Which marketing copy is doing the best? Which things are most effective? Might be different for different kinds of people. So we might want to make a prediction of what piece of copy should we show, or what channel. Should we send a direct mail or an email, or what are these models effective at? It could be very interesting. And so you've got this kind of, who am I targeting? And here, obviously, what we're trying to do is drive down the cost of marketing per an originated loan. If I can better target who I'm marketing to, what channels I'm marketing to them in, what messages I'm marketing to them with, then I can really drive down my cost to acquire. I can improve the economics of my program, or alternatively, continue what you typically find as this gets better. You go, hey, I'm okay with the economics. So if my targeting gets better, right, and targeting can actually improve things like even your approval rate. If I know who to market to better, it might be who's going to respond or who's going to actually qualify for the loan. If I can get that better targeted, then I can actually lower my cost. Things I can actually market to more people cost effectively. So that's really valuable. The second area, which is kind of the one that brought Upstart into the business in general, is the underwriting, the assessment of risk. How risky is it to make this loan to this person or this business? And here, there's so much room. Generally, what you find in the world today is that there's a lot of unexplained risk, right? And you know this, whenever you see loss pools that are 10% or 20%, that's really an estimation saying, hey, we don't really know. Like could be yes, could be no. A perfect model in our world would always say yes or no, have no losses, and give everybody the lowest rate. That would be a perfectly predictive model, and we're a long ways away from that. So there's a lot of unexplained loss in the world of underwriting. And if you can explain more of that loss, if you can be more accurate in your assessment of how risky a given loan is, you can typically, without increasing losses, increase approvals, because you can find in that, if you can take that 10% loss pool and figure out who the 90% are and who the 10% are more accurately, you can lower the rates for the 90. If you can go to that 80% good, 20% bad pool and say, hey, I know who the 80 are, I might have had to decline that whole pool previously to keep my loss rates reasonable. If I can find some portion of the 80, maybe 40 out of the 80, I can actually add those to my approvable world. I can lower my expense to the borrower by lowering interest rates where I better understand the risk. And I can get a more predictable yield if I really understand at a more granular level what the risk in my portfolio is. Then I can actually be more fine-tuned in assigning my interest rates, and therefore understanding my interest rates and my losses. I'm more fine-tuned in understanding what my yield as a lending program is going to be. And so when you can improve underwriting accuracy, it has tremendous ability to increase approvals, to lower rates so you're more competitive in the market, making better offers to more borrowers. And also at the same time, making returns to the institution more predictable. You can obviously dial the returns knob either way in terms of the credit offers you want to make, but you have more control over that when you have a better understanding of risk. The third area, which I think many lending institutions consider like underwriting, we view it a little differently, is what I'll call the onboarding process. And that's really everything from I got an application, I assessed all the information as provided to me and made a risk assessment. I consider that underwriting or a risk. Now I've got the risk of was something in that file misrepresented? Is the income what it said it was? Is the person who they said they were? Are they using the money for what they said they were going to use the money for? Is there something I didn't know about them that's likely to impact my decision, right? And that's another area where I think we see a lot of opportunity to apply machine learning to both increase the accuracy of these decisions, of these estimations of risk here, while reducing the friction to the borrower. And so this is really interesting set of problems for machine learning or for any lender in general, which is that your goal isn't just to minimize fraud. We could do that by having super strict requirements. Everybody comes in with a birth certificate and a social security number and a passport and a driver's license and a utility. You could make a really cumbersome process that would really eliminate any chance of fraud or lying or misrepresentation about income or anything else. But that process would have almost nobody completing it. And so you have to really balance here the concept of the friction or the effort that you require of the applicant to get through the process with the accuracy of the model. And so that's a really interesting trade-off where we're saying, hey, at a certain level of risk of misrepresentation, it might be worth it to let the person go through. I'm 99.999% sure. Am I okay with that? Probably, yeah. And so figuring out that balance, obviously, that's probably too far. If I'm 85% sure, probably not far enough for most things. And so you've got to find this balance for each piece of information you're trying to verify between the cost of requesting more effort to be done by the borrower to validate the information provided and the benefit to you in accuracy or reduction of losses. It's a really interesting fine balance. It's not as clear cut as, say, underwriting decision where you have a yes, no, was it good? We know in the end if a loan repaid or not, so we can determine if we made a good call. Sometimes it's much harder in fraud. And marketing, obviously, you have much more clear outcomes and much more clear things. We want to lower the cost. We want the people who get loans to be the ones who receive marketing. That's, I think, a little easier to handle than this. And then the fourth area, so if you go through marketing, risk assessment, onboarding, I think the fourth area I would talk about is servicing. And that's really a question of who's maybe at risk based on doing regular looks at their credit file as a customer, maybe becoming delinquent. Do we want to proactively reach out? If somebody's delinquent, what kind of outreach, what time of day, what kind of messaging is likely to actually resonate with them, so we can both improve our roll rates, improve our ability to recover borrowers who maybe go delinquent back into the fold, and also reduce the cost of doing that. So we're not wasting a bunch of time calling people who would rather be texted or emailed. We're utilizing our resources effectively to get the outcomes we want of borrowers being able to come back onto repayment. So all of those areas, I think, are really ripe for the use of machine learning to make better predictions about who to market to and how, who to give offers of credit to and what kinds of offers, what kind of requests to make through the verification and onboarding process of the customer to validate information provided, and what can we use through automated mechanisms or just believe based on the information we already have, and who and how should we be reaching out to people who we think are either delinquent or at risk of becoming delinquent. Or they're all prediction problems, right? They're all things that we have historical experience of, training data that we can apply to a prediction we need to make. Is this person likely to go delinquent? Is this person likely to respond and get a loan? Is this person likely to repay? That helps us improve the outcomes of a lending program. So I think you'll see machine learning, AI applied across all of these. We're at different states of sophistication within the industry at each of them. But I think those are really all very ripe areas for the application of this kind of technology. And then the last thing I want to talk about a little bit was some of the core challenges. When you say, hey, I'm going to go apply machine learning to one of these challenges, one of these areas, I want to go do it for, and I'll talk a little bit about different examples from each of those four. But what should I be aware of? What should I be thinking about as potential problems or challenges or decisions I need to make? So the first one is machine learning takes a lot of data. And one of the core questions you have to ask is, do I have enough data? And by enough data, I really mean both the rows, the examples. For underwriting, it might be historical loans. And do I have enough columns, enough pieces of data? And this is an interesting challenge. There's also the question of, am I going to use what I will call first-party data, my own data? In the case of an underwriting model, maybe it's my own historical portfolios to train. Am I going to use third-party data where I might go do a retro with a credit bureau and I can pull a bunch of information on that? In the case of a retro, there's limitations, right? I may have fewer columns available. I might have less granular repayment data. I might know good, bad, but I might not know month-by-month repayment history. So things like predicting timing of possible defaults, predicting prepayments might be things you want your model to do. And it might not have the data from a third-party source. But your first-party source might not have enough rows to actually train a more sophisticated model. So there's really interesting challenges in how do we get to enough volume of data for the purposes we want. One of the other challenges when it comes to quantity of data is, do I have enough good and bad examples? And my favorite example here is fraud, right? Where if you're doing a really good job fighting fraud, you don't have a lot of examples of what successful fraud looks like because you caught it and it didn't get through. And those people may not come to you as much. And so you may have lesser experience of, yeah, this was fraud. And so your models might not be able to train as easily. This is a place where there's often a lot of utilization of third-party data sources and models, maybe even training models, because it's, if you're doing it well, you don't have enough. Same thing can be true in loans. If you're identifying all the goods, you don't know the bads. And this can be challenging, particularly if you want to expand the kinds of loans you're doing. I'll talk about that in a minute in generalizing your model. Another challenge, I think, in terms of getting enough data is the question of, if I want to use alternative data, information that maybe is not generally available, I probably am tied to first-party data, right? If something that I can't get from a credit bureau about applicants historically, then the place where I can have that data is when I collect it. But of course, then I only have it on the people for whom I've collected it. So this represents what we call often a kickstart challenge, kind of like, how do I get enough data about what these variables, these pieces of information might tell me about creditworthiness, likelihood to respond, likelihood of fraud, without having had them on historical portfolio. And so there's a real challenge in how do you get to a place where you have enough points of data of the different kinds to build models. And that's why as you use models more, you get more data, and your ability to do more interesting feature engineering might increase because you have more data points and you're starting to see trends as you look at it. Your ability to use a more sophisticated model type or shift to a more sophisticated outcome prediction that you're looking for, moving from a binary good bad to maybe a probability of default to maybe a timing of default or timing of prepayment. Those things might shift as you have enough data within your system to actually make a more sophisticated prediction using a more sophisticated form because you've been lending. It's one of the challenges in lending is you have to lend money to get the training data to train these models. So it's a real, like I said, a kickstart problem of how you get going. And in case of lending, it takes money and takes putting risk in the game. The second thing you've got to ask is like, not only do I have enough data, but is the model I'm building going to generalize from the data that I have to the examples that I will see in the future? Because I've got this historical pool, and I want to know, like, does this pool an accurate representation of what the pool of people I might be making decisions about in the future going to look like? And therefore, will this model be as accurate on future applicants as it is on the training data set? And this is one of the core problems for any machine learning challenges, like, is the future going to look like the past in some real way? And here, there's a couple of interesting things to think about. A great example of this is, let's say we want to use machine learning to expand our credit box, right? Well, that's great, but if I've never lent to people below a certain credit score, then I don't know if my model generalizes that well from where it's been trained, where the training data is, to people who have lower credit scores. It seems like maybe it should work. Here's a place where you might ease your way into something. You might say, hey, we're going to lower it 10 or 20 points and allow ourselves to build training data on a slightly lower credit segment. You might work with a third party who's been lending in different segments. You might use a retro from a bureau data, but you've got to really question, how do I make sure that the data I have is generalizable if I'm moving to new geographic markets, if I'm getting into new kinds of credit products. Another great example of this is bias you might have in your training data in terms of the macroeconomic environment. If your training data, if you're using your own lending portfolio and it's predominantly in a positive economic cycle, it may not be a good generalizable model for what happens in a more stressed economic scenario. This is one of the core problems for machine learning models that have been built recently, is how do I account for both, is my model going to maintain accuracy, but is it going to be overly optimistic as we enter a more stressed environment? And how do I account for that in terms of my overall credit decisioning process, in terms of my model adjusting for that kind of challenge, right, is a really good one. So that's a great example of generalizable. One of the core things that you can do is looking for the edges of your model where it might not generalize, making sure as you build your training data set that it is representative of the overall problem you're trying to solve, the question you're going to be asking, and making sure that, again, that the outcomes that you're using historically are representative of what you want the outcomes to really look like, not maybe biased outcomes that you're using to train, because you will learn from those things. So I think going from do we have enough data to train a model to have we built a model that's going to generalize? Have we seen enough examples of fraud? What's going to happen when there's competitive dynamics in the market that maybe change? How do I think about responding to those is a really tough challenge. And the last thing I want to say is not a specific challenge, but I think it's an area as you get into machine learning that is often underappreciated, which is just the execution quality required to do this well. I think in some circles now there's a sense that like machine learning is like a tool, and we point it at a problem and it solves the problem, and that there's some sort of commodification of the execution within AI. That hey, this person's using machine learning, that person's using machine learning, they're using machine learning. It's going to kind of tell you the same thing, and I got to tell you that is not at all the case, right? Like any challenging area, like a sport, like anything else, it takes hard work, dedication, and time to get good at this. And even at a company that's been doing this for nearly a decade, we still have a long way to go, even in the core problems we started on, because you just are constantly finding ways to improve the feature engineering, the model forms, the training data you're able to use, the techniques. It's really hard to do this well. It's not simple. It's not commodified in the sense that anybody can kind of take an off-the-shelf model. I'm going to go grab XGBoost library, throw out some historical loan portfolio, and it's going to you can get real improvements, I think, in many cases from the status quo in that way. I will say some of these challenges apply. You can get things that look really good in training data and they look really good from an accuracy metrics and don't apply well in the real world because you didn't have a generalizable training data set. You miss something. And then I think there is just a tremendous difference between a first iteration of a model and what you can develop over time through hard work and execution in the space. So I would just say, don't underestimate the need to put time and effort. Your first iteration is never the best, right? There's always places and ways to improve. We still think dramatic ways for us to improve at Upstart and all of the models we use, because it's just not an easy thing to apply this. It's an evolving state of the art, and it's a really interesting space, but it's also a challenging space. So I would just, I think it's easy to underestimate how hard it is to do these things, how hard it is to get enough of the right kinds of data that's broad enough to make a model that generalizes into the real world, and that executing that and doing all of these things, picking the right outcome prediction, picking the right model form, finding the right accuracy metrics, building the right data sets, right, both through feature engineering and other efforts, is non-trivial work, and it's hard to do right, and it really accrues tremendous benefits to those who do it well. So those would be my three things to look out for, right? Is like, do you have enough data, the right kinds of data, breadth and depth of data? Is the model construct you're using going to generalize from the training data sets you have to the general problem you're going to solve? Or are there places where maybe there's challenges you need to think about, be very cognizant of that? And number three is, like, don't underestimate the import of execution and time to execution. Like, the machine learning scientists are learning just like the machine learning models are learning. They're learning over time, and their data set, their training data, is models they've built and models they've trained and the results of those models. And so it takes iterations for your machine learning team to build the ideal models. And sometimes it just takes data. Like, we need to accumulate data to actually be able to improve on these different areas, to have more trained data to allow us to use different forms, to make more precise predictions, to have more refined accuracy metrics. So all of those things are really critical to get right. They're easy to get wrong. But I think there's such tremendous opportunity to apply AI and ML to marketing opportunities, to underwriting risk, to onboarding and friction reduction, to servicing, that it's clear to me that all the winners in lending will be leveraging these technologies across all of those areas over the next 5 or 10 years. And I think it's really behooves anybody in the lending industry to understand these technologies better, to understand how they work, to understand, not in depth, but the core of how they work, like we've talked about today, to understand where they can be used, and to understand the questions you need to be asking to make sure you're executing them well, and finding the right models, or partners building models, or are building the right teams and processes to build the models that are going to be effective for your use case, because I think it's easy to go the other way. So that's my quick intro to machine learning and AI for lenders. I'd love to get some feedback on if you guys enjoyed this discussion. We can certainly dive deeper on specific topics of fairness or model forms or anything else. Just let me know what you guys want to hear about. But we're happy to delve a little bit more into the area of AI, because I think it is a kind of leapfrog technology in terms of capability for producing accurate predictive models, and that is going to really revolutionize many industries, but lending in particular. And so it's a great time to be learning about machine learning and AI and how it's going to apply to your industry and your business.